You've heard this story your whole life. When the Federal Reserve cuts interest rates, the economy breathes easier. Markets rally and everyone celebrates like something meaningful just happened. But if rate cuts are such a blessing, why does life feel harder every single year for the middle class? Here's the truth no one says out loud. When money gets cheaper, opportunity doesn't expand. It shifts, and it rarely shifts in your direction. The public narrative tells you that lower rates lead to more growth, more jobs, and more optimism. But the hidden truth is that rate cuts don't fix the economy. They rearrange the economy. They transfer wealth from workers to owners, from savers to borrowers, from the middle class to the top 1%, every single time. Right now, the federal funds rate is hovering around 4.11%, and the Fed expects it to fall below 3.5% before 2026. For investors, that's a signal. For everyday Americans, it's another tightening of the vice. Because cheap money doesn't flow into paychecks, it flows into portfolios. When borrowing costs fall, the people who already have access to credit do the same thing they always do. They borrow billions, not to innovate, not to expand production, but to buy assets. Hedge funds borrow, corporations borrow, private equity borrows. They inhale cheap credit like oxygen because they know one rule. When money is cheap, assets become a weapon. Meanwhile, the average worker, who holds most of their savings in cash, gets nothing except rising prices. That's why the wealth of the top 0.1% has nearly doubled since 2020, soaring past $23 trillion, while savings accounts collapse to near zero yields. Cheap money widens the gap. It accelerates it. It locks it in place. Those who own assets watch their wealth inflate like a balloon, while those who don't scramble to afford the rising cost of survival. Groceries, rent, healthcare, utilities, everything moves up, except wages. Because the truth is this, lower interest rates don't raise wages, they raise prices. That's why a modest American home now requires a six-figure income, while the median household brings in only around $70,000. Home ownership, once the symbol of the American dream, is now a luxury reserved for those who already had a head start. And those who own property, they watch their home values explode simply because the Fed keeps injecting liquidity into the system. A policy designed to stimulate growth quietly becomes a machine that transfers wealth upward. Savers get punished, investors get rewarded, inflation becomes the tax, cheap credit becomes the loophole. And in the middle of this distortion, another force tightens the pressure. Geopolitical conflict. The United States and China are locked in a long-term economic war. Tariffs rise, export controls intensify, supply chains crack. And who pays for all of this? The American consumer. Electronics, cars, clothing, furniture, even basic food items all become more expensive because importing gets more expensive. Meanwhile, wages barely move. The middle class finds itself squeezed by two forces it cannot escape. Easy money pushing asset prices higher and trade tensions pushing everyday prices higher. The result is brutal but predictable. You can't afford to invest, and you can barely afford to live. Economists call it the wealth effect. When asset prices rise, the rich feel richer and spend more. But for most Americans, the wealth effect feels like the cost effect. Housing becomes a mountain you can't climb. Education becomes a financial risk. Healthcare becomes a luxury. Groceries become a weekly fear. And behind the scenes, something even more dangerous is happening. Low interest rates trick corporations into believing debt is harmless. So they borrow billions. Not to innovate, not to build factories, but to buy back their own shares, inflate their earnings, and make executives richer. It looks like growth on paper. It feels like decay in real life. Because every debt-fueled buyback today is a vulnerability tomorrow. After the 2008 crisis, the Fed printed trillions to stabilize the system. It was necessary, but what was meant to be temporary became permanent. Markets learned a new belief: no matter what happens, the Fed will save us. And once investors believe the downside is protected, speculation becomes culture, risk becomes entertainment, and bubbles become routine. When money has no cost, markets lose their discipline. People stop asking whether something is worth its price. They only ask whether it will go up. This is how value disappears and illusion takes over. And just as cheap money inflates financial markets, trade tensions drive consumer prices higher. Together, these pressures collide and trap the middle class in a tightening vice. On one side, assets soar far beyond what salaries can match. On the other, the cost of living rises faster than wages can chase. What fills the gap? Debt, credit cards, car loans, personal loans, buy now pay later schemes. Debt becomes the bridge between what life costs and what people can actually afford. But that bridge gets longer every year, and eventually, it cracks. Meanwhile, the wealthy borrow at 2 or 3% to buy assets that return 8, 10, sometimes 12%. The poor borrow at 20% just to survive. Same system, same currency, but two entirely different realities. And that is why more economists now argue that modern monetary policy, easy money, low rates, and endless liquidity has become one of the biggest engines of inequality in American history. Money no longer flows across the economy. It pools around those who know how to use it. And the more it pools, the more power concentrates at the top. But even within a system that seems rigged from the start, there is still a lesson, a signal, and an opportunity, if you know where to look. Because the truth is this: cheap money doesn't just inflate markets, it distorts behavior. Corporations borrow not because they need capital to grow, but because debt becomes the easiest way to manipulate valuations. Families borrow not because they want luxury, but because necessities have drifted so far out of reach that debt becomes the only bridge left. Governments borrow because political cycles demand quick wins instead of long-term stability. And somewhere in the middle of this, ordinary people are left trying to survive inside a financial architecture they never designed. When interest rates stay low for too long, something even more dangerous emerges: fragility. The entire system becomes sensitive to shock. A tariff war can shake it. An oil spike can destabilize it. A geopolitical conflict can fracture it. A supply chain disruption can break it. Because when everything is built on cheap credit, everything becomes vulnerable to anything that disturbs the flow of money. This is how recessions begin, not with a crash, but with a loss of confidence. Not with chaos, but with imbalance. And right now, the imbalance is everywhere. Debt levels are higher than ever. Corporate leverage is at record highs. Consumer debt has passed historic levels. And financial markets, propped up for years by ultra-low rates, are beginning to show cracks beneath the surface. The Fed knows this. That's why every decision feels like choosing between two disasters. If they cut rates further, they risk inflating yet another bubble, one even bigger and more dangerous than the last. If they raise rates, they risk suffocating growth, triggering layoffs, squeezing businesses, and sending the economy into recession. For ordinary Americans, the outcome feels identical. Housing stays expensive, groceries stay expensive, healthcare and education rise faster than paychecks can follow. So people borrow more, they stretch credit, they refinance, they hope things will get better. But hope is not a financial strategy, and cheap money is not a solution. It is a delay, a mask, a temporary illusion. Meanwhile, the wealthy use this environment as fuel. They borrow at 2% to buy assets returning 8%. They compound their wealth. They scale their portfolios. They buy income-producing assets that continue to grow in value, while those at the bottom borrow at 20% just to make ends meet. It is the same system, but two completely different games. That's why more economists now argue that Modern monetary policy is no longer about growth. It's about distribution. It dictates who benefits and who falls behind. It decides who gets richer and who gets squeezed. Money doesn't disappear. It moves, it transfers, it flows from the hands of those who don't understand the system into the hands of those who do. And once you see that pattern, you cannot unsee it. Because history shows something that textbooks never fully explain. Every era of easy money eventually ends with a correction. A moment where illusion meets reality. A moment where inflated prices collide with real value. A moment where markets finally ask the question they've been avoiding. What is this actually worth? And when that moment comes, the people who survive aren't the ones who chase the highest returns. They're the ones who sought the strongest foundations. Real cash flow, real production, real innovation, real value. Not hype, not speculation, not momentum. Real, tangible value. The kind that doesn't evaporate when interest rates change or when headlines shift. The kind that remains standing when markets shake. And that is where the opportunity lies. Not in predicting the Fed, not in timing every cut or every hike, but in understanding the structure beneath the noise. For everyday people, the principle is the same. You cannot control the stock market. You cannot control the Fed. You cannot control global trade. But you can control where your money goes. You can make sure your savings don't sit idle and get devoured by inflation. You can learn about simple, long-term investments. Index funds, bonds, or even small allocations of gold. You can choose to own assets instead of letting rising prices push you further behind. Because in a world where the cost of everything keeps rising, owning something real is no longer a luxury. It is a necessity. For nations, the lesson goes even deeper. Countries that rely too heavily on cheap money or foreign credit eventually lose control of their economic destiny. They become fragile, dependent, exposed. Only nations that build real production, real industry, and real innovation can withstand the storms of global finance. Easy money can buy time, but it cannot buy strength, and maybe that is the truth hidden inside all of this. In an age where policies shift overnight, where markets react in milliseconds, and where entire economies can tilt from a single decision, the only real power left is understanding. The mindset to look beyond headlines. The discipline to avoid emotional decisions. The clarity to see how money moves through the system. Because at the end of the day, money doesn't vanish. It transfers. From the impatient to the patient, from the uninformed to the informed, from the people who react to the people who prepare. And as interest rates begin their next cycle, as global tensions rise, as markets grow more fragile, the people who will come out stronger are the ones who understand how this system truly works. Not the ones who fear it, not the ones who ignore it, but the ones who study it, observe it, and make intentional decisions when everyone else is distracted by the next Fed headline. If this video helped you understand how central bank decisions shape your wallet, your future, and your financial stability, make sure you subscribe. Because in the world of money, knowledge isn't just power, it's survival. And that brings us to the final pattern, the one almost nobody sees until it's too late. Interest rates are not just numbers on a chart. They are signals. They tell you where money will move next. They reveal who will get squeezed, who will get rescued, and who will quietly rise above the noise. When rates fall, speculation accelerates. When rates rise, leverage gets exposed. When rates stay flat, imbalances grow in silence. But through every cycle, one rule never changes. The people who understand how money flows will always be one step ahead of the people who only watch prices move. Because what most people don't realize is this: every boom has a cost, and every correction has a purpose. Markets don't move randomly. They move in cycles: expansion, excess, correction, recovery, and rate cuts often arrive not at the beginning of opportunity, but at the end of a cycle. that has already stretched too far. They are not a celebration. They are a warning, a sign that something beneath the surface is weakening, a sign that the system needs artificial support to stay balanced, a sign that investors should shift from chasing momentum to building resilience. And resilience doesn't come from hype stocks or overnight trends. It comes from companies with real earnings, real demand, real durability. It comes from assets that hold value when liquidity dries up. It comes from understanding time, not timing. Because while everyone else tries to guess what the Fed will do next, the smartest players prepare for what comes after. They look at debt levels, not headlines. They look at demographic trends, not short-term noise. They study energy, production, supply chains, real output, things that don't change overnight. And they position themselves for the long game while the crowd gets distracted by the short one. That's why in every economic era, from the 1970s inflation crisis to the 2000 dot-com crash to the 2008 financial collapse, the winners were not the ones who predicted the exact moment of collapse. They were the ones who understood the structure of the system before it collapsed. They were the ones who saw the underlying patterns. Too much debt, too much speculation, too much confidence in things that were never real to begin with. And today those same patterns are returning. The world is entering a new era, one defined by unstable interest rates, fragile supply chains, rising geopolitical conflict, and a financial system stretched by decades of easy money. This is not a time for blind optimism. It is a time for awareness, discipline, intelligence. Because the truth is, you can't control the Federal Reserve. You can't control China, or global trade, or the price of oil. But you can control how prepared you are. You can control whether you understand the forces shaping the world or get swept away by them. You can control whether you react emotionally or strategically. And in a world where money moves faster than ever, the advantage belongs to the people who think, who observe, who act with intention. The next decade will not reward the loudest voices. It will reward the sharpest minds. The ones who see the shift before it becomes obvious. The ones who understand that every rate cut, every shock, every disruption is not the end of the system, but the beginning of the next chapter. And if you want to navigate that chapter, stay here. Because in the world of finance, knowledge isn't just freedom, it's armor.